One of the most frustrating things about investing is that recoveries almost never feel like recoveries while they're happening. When markets fall, the fear is loud. It's everywhere. It dominates the news. It fills conversations. It sits in the back of your mind every time you check your portfolio. But when markets begin to recover, the feeling is completely different. There's no announcement, no celebration, no moment where everyone agrees the worst is over. Recoveries begin quietly, almost invisibly, and that silence is exactly what makes them so easy to miss. This is one of the most important and most misunderstood patterns in long-term investing, and understanding it can change the way you think about risk, patience, and time. To understand why recoveries feel invisible, we first need to understand what people expect a recovery to look like. Most investors imagine a recovery as the mirror image of a crash. They expect that if the decline was loud and dramatic, the rebound should feel equally clear and decisive. They expect a turning point, a signal, a moment where the headlines shift from fear to optimism, a day where it becomes obvious that the worst has passed. But that's not how it works. In reality, recoveries don't begin when things feel good. They begin when things still feel terrible. They begin during periods of maximum uncertainty, when the news is still overwhelmingly negative, when economists are still debating how much worse it could get, and when most investors are still frozen in place. This isn't a coincidence. It's a structural feature of how markets operate. Markets are forward-looking. They don't wait for confirmation that the economy has healed. They don't wait for unemployment to improve. They don't wait for corporate earnings to bounce back. Markets begin to recover when the rate of deterioration slows, not when things are actually good again. That's a subtle but enormously important distinction. Think about that for a moment. The market doesn't need good news to start climbing. It only needs less bad news. It needs the pace of decline to slow. It needs a reason, even a fragile, uncertain one, to believe the worst-case scenario is becoming less likely. And that signal almost never matches the emotional state of the people watching. Let's look at a few examples from history, not to predict anything, but to observe this pattern in action. In March of 2009, the S&P 500 hit its lowest point during the financial crisis. At that moment, fear was at its peak. Banks were failing. Unemployment was rising rapidly. Headlines were filled with worst-case predictions about the global financial system. Nobody was talking about a recovery. The dominant emotion was dread. And yet, that exact moment, when fear was loudest, was the beginning of one of the longest bull markets in history. By the time confidence returned, by the time headlines turned positive, by the time people started saying it was safe to invest again, markets had already risen significantly. The biggest gains of the recovery happened while most investors were still afraid. This same pattern appeared in 2020. In March of 2020, markets crashed at a speed that shocked even experienced professionals. A global pandemic had shut down economies. Businesses closed. Travel stopped. The world felt like it was pausing entirely. The fear was overwhelming. Many investors sold everything. Others froze completely. But markets bottomed in late March 2020, while hospitals were still overwhelmed, while lockdowns were still expanding, while nobody could predict when normal life would resume. The recovery began in the middle of the crisis, not after it. By the time people felt safe enough to invest again, a massive portion of the rebound had already taken place. This is the pattern. It repeats across decades, across different causes, across different economic conditions. Recoveries do not wait for permission from human emotion. They move first. Confidence follows later. So why does this keep happening? Why do recoveries always seem to begin before anyone is ready for them? The answer has two parts, one structural and one psychological. The structural reason is straightforward. Markets are made up of millions of participants making forward-looking decisions based on expectations, not current conditions. Professional investors, institutions, and algorithms are constantly pricing in probabilities about the future. When the probability of a worst-case outcome decreases, even slightly, capital begins to move. That movement doesn't require optimism. It only requires a reduction in fear. This is why bottoms form during extreme negativity. The sellers have already sold. The fear has already been expressed in prices. And when even a small amount of buying pressure returns, the recovery begins, quietly and without fanfare. The psychological reason is equally important. Human beings process fear and relief on very different timelines. Fear arrives quickly. It's sharp. It demands attention. It triggers immediate responses, checking portfolios, reading headlines, talking to others, seeking reassurance. Relief, on the other hand, is slow. It builds gradually. It doesn't arrive as a single moment of clarity. It creeps in over weeks and months as bad news gradually becomes less bad. This mismatch between fast fear and slow relief is why recoveries feel invisible. Your brain is still processing the crash while the market has already started moving in the other direction. And because relief is slow, most people don't recognize the recovery until it's well underway. By then, they've already missed a significant portion of the gains, not because they made a wrong decision, but because they were waiting for a feeling that always arrives late. This leads to one of the most common and most costly patterns in investing. People sell during the decline. Then they wait for certainty before re-entering. And by the time they feel confident enough to invest again, they buy back at prices higher than where they sold. They don't do this because they're foolish. They do it because the emotional signal, confidence, is a lagging indicator. It tells you where the market was, not where it's going. This is the trap that catches even experienced investors. You cannot wait for confidence and also capture the recovery. Those two goals are in direct conflict. The recovery begins precisely when confidence is at its lowest. That is not a coincidence. It is the mechanism. Now, understanding this doesn't mean you should try to time the bottom. Nobody can do that reliably. Not professionals, not algorithms, not anyone. What it does mean is this. If you are investing for the long term, 10, 20, 30 years, the single most valuable thing you can do is stay invested through the periods that feel the worst. Not because it feels good, it doesn't. Not because you're certain things will improve, you won't be. But because history shows, consistently and repeatedly, that the cost of waiting for confidence is almost always higher than the discomfort of staying the course. The people who benefit most from recoveries are not the ones who predicted them. They're the ones who were still invested when they began. That's an uncomfortable truth, but it's a reliable one. There's a reason this pattern is so hard to act on, even when you understand it intellectually. It's because knowledge and emotion operate on different systems. You can know that recoveries begin during fear. You can read the data. You can study the history. You can believe it completely. And still, when your portfolio is down 30%, and every headline says things are getting worse, your instinct will tell you to protect what's left. Your emotions will scream that this time is different, that waiting is safer, that doing nothing is the rational choice. That emotional experience is real, it's valid, and it's exactly what every investor before you has felt at the same moments in history. The difference between investors who capture long-term returns and those who don't is rarely intelligence or information. It's the ability to sit with discomfort and not let it override a long-term plan. That ability is not natural. It's practiced. And it starts with understanding the pattern before you need to live through it. Market recoveries begin before confidence returns. They always have, and there's no reason to believe they won't continue to. The question is not whether you'll experience fear during a downturn. You will. The question is whether you'll still be invested when the recovery begins. Quietly, invisibly, and long before anyone tells you it's safe. This is the Long View Finance. You'll find more videos here exploring money, markets, and financial history with long-term perspective.